Institutions are responsible for a huge volume of trading. Their deep pockets give them several advantages. They pay low institutional commissions. They can afford to hire the best researchers, brokers, and traders. Some even strike back at floor traders who steal too much in slippage. The spate of arrests and trials of Chicago floor traders in 1990 and 1991 began when Archer Daniels Midland, a food processing firm, brought in the FBI. A friend of mine who heads a trading desk at a bank bases some of his decisions on a service provided by a group of former CIA officers. They scan the media to detect early trends in society and send their reports to him. My trader friend culls some of his best ideas from these reports. The substantial annual fee for those experts is small potatoes for his firm compared with the millions of dollars it trades. Most private traders do not have such opportunities. It is easier for institutions to buy the best research. An acquaintance who used to trade successfully for a Wall Street investment bank found himself in trouble when he quit to trade for himself. He discovered that a real-time quote system in his Park Avenue apartment in Manhattan did not give him news as fast as the squawk box on the trading floor of his old firm. Brokers from around the country used to call him with the latest ideas because they wanted his orders. When you trade from your house, you are never the first to hear the news, he says. Some large firms have intelligence networks that enable them to act before the public. One day, when oil futures rallied in response to a fire on a platform in the North Sea, I called a friend at an oil firm. The market was frantic, but he was relaxed. He had bought oil futures half an hour before they exploded. He had gotten a telex from an agent in the area of the fire well before the reports appeared on the newswire. Timely information is priceless, but only a large company can afford an intelligence network. The firms that deal in both futures and cash markets have two advantages. They have true inside information, and they are exempt from speculative position limits. Recently, I visited an acquaintance at a multinational oil company. After passing through security that was tighter than at Kennedy International Airport, I walked through glass-enclosed corridors. Clusters of men huddled around monitors trading oil products. When I asked my host whether his traders were hedging or speculating, he looked me straight in the eye and said, "Yes." I asked again and received the same answer. Companies crisscross the thin line between hedging and speculating based on inside information. Employees of trading firms have a psychological advantage. They can be more relaxed because their own money is not at risk.